One of my favorite uses of the SBA 7A loan program, expansion through acquisition. Now think about this. You're an existing business, things are going great. However, you're ready to take it to that next level, ready to jump revenue. The only thing holding you back are the resources. You got a couple options. You can go, make a bunch of hires, increase your marketing advertising budget, buy new equipment, or you can buy a competitor, an existing cash flowing business to help jump your revenue, sometimes double it, in a matter of 60 days. This episode will be about expansion through acquisition utilizing the SBA 7A loan program. For an existing business looking to grow quickly, you can actually utilize the SBA 7A loan program to buy a competitor. Now, the benefit of that is you can actually buy that competitor with potentially 0% down, and we'll get into that here shortly. So the obvious benefit to you as the business owner by buying a competitor is the growth, maybe new territory, instantly getting new employees that know exactly what they're doing, they're trained, getting their vehicles, getting their equipment, an instant jump to your bottom line. And one of the biggest benefits of it is this transaction can technically be 100% financed. Yes, you heard correctly. You can buy another business without putting a single dollar of your own down. Now, obviously, there's a few requirements that have to be met to be able to do so. The first thing is it has to be considered the same business type, the same NAICS code. And for those that don't know, and I wrote this down, what is a NAICS code? It's the North American Industry Classification System. So when you look on your tax return, you'll notice there's a 6-digit code. Technically, to be qualified as an expansion, it has to match. Now, that's an SBA rule. You have to match the same NAICS code as the company that you're buying. Another eligibility item to consider is that's in the same regional area as your current business. If you're in Florida and you're trying to buy a business in California, you're gonna have to explain to the lender how you're gonna be able to do both. And if your plan's not to be in California, it's gonna be a difficult conversation. Now, the SBA says regional, so regional can be within an hour, can be the state next door, but just be prepared to discuss on how you're going to manage your company and the new company that you're going to be taking over. Another benefit of the SBA 7A program when doing an expansion through acquisition is that you can build in some alternate uses for the funds. Think about getting some working capital back, think about buying some new equipment. It can all be tied in. Another thing to keep in mind is if you're buying another business, they might have an office space. What's going to happen in that office space? Are you going to need it? Do they own their commercial real estate? Maybe you're renting yours. Does it make sense to move into one location? These are things that can obviously help not only benefit the business, but boost cash flow. There'll be redundancies and expenses in those scenarios. So let's talk about cash flow for these type of transactions, right? Because you've got your business and you got the business you're buying. Now, technically, most lenders are going to want to see that the business you're buying can support the debt on its own at some level. Obviously, from a global standpoint, when you add in your business cash flow on top of that business cash flow, it's only going to help strengthen it. And you really need to understand the story. Do you need the same amount of employees? Are there going to be multiple employees doing the same thing? Do you need to keep everybody? So what are some of the cost-cutting measures that you're going to make immediately upon having two companies that might be doing similar items? So be prepared to have that information ready for a lender to review. Be prepared to put into writing the benefits of the expansion. It's not going to make sense to have two different marketing advertising budgets. So could you combine it into one? That could be an add back. Really put into thought some of the expenses that the business you're buying is having and make note if they're going to go away upon acquisition. That can help strengthen the cash flow. It can help you get approved for more. So if you're looking to build in working capital, maybe some equipment, and you want to put 0% down, the stronger the cash flow, the higher the amount that you're going to get approved for. Also make note of the owner outgoing on the business you're buying. What was their role? Are they going to need to be replaced? It's important to understand their employees. Did they have key employees, key managers, any licensed employees that might be leaving post-transaction? You need to know exactly what you're inheriting when you're buying this business. And you need to be able to explain to the bank what those benefits are as well. And don't forget the due diligence that'll need to be done on this transaction. Very similar to the due diligence done on a regular business acquisition. So the first thing I always like to point out is the business valuation. Now, in terms of cash flow, obviously we're going to have your existing business as part of that. But that doesn't mean it's going to be included when looking at the business valuation. So if the business you're buying is struggling with cash flow and with your business cash flow strong, that could end up being an issue with valuation. So the valuation still has to come back at a certain amount to pass the SBA eligibility test. Also keep in mind that any debts of that existing business will need to be paid off. Any vehicles, equipment that business might own might need to have their titles collected and be included as part of the collateral. And any insurances and licenses will need to be updated to reflect the new entity. So keep in mind all these due diligence items as part of the post-approval process. At the end of the day, just like with a regular business acquisition, the bank is going to want to know that you're buying a nice, clean business that values out, doesn't have any liens, and has all the license it needs to continue operating under your umbrella. One thing to keep in mind is you can include a seller's note as part of the expansion through acquisition. So if you want the seller to help finance part of the transaction, it is allowed. Some buyers like it because that means you have an outgoing seller that still has a vested interest in the success of the business. So it can also be part of the negotiation. Just know that, yes, it is eligible for 100%. You might have to put money down depending on the cash flow. And also you can build in additional funds for working capital, equipment, and other items like that to help grow the business. So any current business owner looking for different ways to grow their business, consider the acquisition route, utilizing the SBA 7A loan program. I hope you found value in this lesson. Until next time, class dismissed. Thank you for watching this episode of SBA University. Hopefully you found this episode helpful. If you need to get a hold of me directly, I'll leave my email address down in the description. Be on the lookout as I will be releasing new lessons every week to help you in your SBA journey. Thanks.